Understanding market trends is one of the most important skills in trading and investing. In 2026, markets move faster, react to more data, and are influenced by a wider range of global factors than ever before. For many traders, the challenge is no longer access to information, but knowing how to interpret it correctly. This guide explores how professional traders read market trends and how structured analysis helps separate real signals from market noise. A market trend is not just a direction on a chart, it is a reflection of underlying forces such as capital flows, macroeconomic expectations, and investor sentiment. An uptrend typically forms when demand consistently exceeds supply, while a downtrend reflects sustained selling pressure. However, most markets do not move in straight lines. They develop through phases: impulse moves, corrections, and consolidations. Professional traders focus on identifying the structure behind these movements rather than reacting to every price fluctuation. Reading trends begins with understanding market structure. This includes identifying higher highs and higher lows in an uptrend, or lower highs and lower lows in a downtrend. Structure provides context. A temporary pullback does not necessarily mean a trend has reversed. It may simply be a correction within a larger directional move. By focusing on structure, traders avoid overreacting to short-term volatility and instead align their decisions with broader market direction. Technical analysis alone is often not enough in modern markets. Price patterns need to be interpreted alongside macroeconomic conditions. Interest rates, inflation data, and global liquidity influence how capital moves across markets. For example, a strong trend in commodities may be supported by inflation expectations, while currency movements may reflect central bank policies. Professional traders combine chart analysis with macro context to understand why a trend exists, not just where price is moving. Not all trends are equally strong. Some develop with consistent momentum, while others show signs of weakness or exhaustion. Trend strength can often be observed through price behavior. Strong trends tend to move with clear direction and shallow corrections. Weak trends may show irregular movements, frequent reversals, or declining momentum. Understanding this difference helps traders decide whether to follow a trend or remain cautious. One of the most common mistakes is trying to predict every market move. Professionals focus on probabilities, not certainty. Another mistake is ignoring context. A breakout may look strong on a chart, but fail if it contradicts broader market conditions. Overtrading is also a frequent issue. Not every movement requires action. Sometimes the best decision is to wait for clearer confirmation. Even when a trend appears strong, risk management remains essential. Markets can reverse unexpectedly, especially during major economic events. Professional traders define risk before entering a position. They use structured approaches to manage exposure and avoid emotional decisions. This disciplined approach allows traders to stay consistent even when market conditions change. Short-term volatility often distracts from long-term trends. Markets may fluctuate daily, but larger movements are usually driven by fundamental changes in the economy. Professional traders balance short-term opportunities with long-term awareness. They understand that sustainable results come from consistency rather than isolated trades. Reading market trends like a professional is not about predicting the future. It is about understanding structure, context, and behavior. The FinanceStPierre approach emphasizes combining technical analysis with macroeconomic awareness, maintaining discipline, and focusing on long-term consistency. In 2026, the ability to interpret trends accurately is not just an advantage. It is a necessity for navigating increasingly complex financial markets.